Howdy, Jacob here. Today we're looking at Civeo Corporation, 391 million market cap on 431 million enterprise value in the commercial services and supplies industry. Again, for sub-billion dollar companies, I do like to look at insider ownership, and we see almost 10%. So pretty good amount of management, CEO, CFO, board owns the company. And so that gives you a higher probability that if you're the investor, that management's going to do what's best for the business as they themselves are heavily invested in the business. So they provide hospitality services to the natural resource industry in Canada, Australia, and US. They develop lodges and village and mobile assets, including modular skid mountain accommodations and central facilities for short or mid-term. Okay, interesting. That's an interesting concept. Founded in 1977 out of Houston, Texas. Growth is actually down from 10 years ago, but is up pretty high from 2017. So we're going to have to look and see if they sold off a bunch of assets here, because revenue declined from 943 million to 382 million in 3 years, but is back up to almost double what it was in 2017. Earnings, making money seems to be a bit of a problem for them. Maybe they sold off tough making assets over here to make some money. That could be a possibility. We're not looking at a whole lot of money making, so I'm going to look at the income statement, see what's hindering them from an expense standpoint. It looks like sales, general, and admin is relatively flat. Cost of goods sold as well is generally flat, but a huge decline in other operating expenses. So I definitely, if I were to do more research, look at what kind of things they sold off for their other expenses to be going down. Again, they're making money, though, in the most recent 3 years, which is positive. So let's look at that balance sheet. We see 3 million cash on hand, with no short-term debt, 66 million long-term debt. I mean, 66 million long-term debt is not a lot, but 3 million cash is definitely not a lot. I definitely am more conservative in the standpoint that I do prefer a little bit of cash on hand in relation to debt. We're going to have to see on the balance sheet or the statement of cash flows whether that debt is a lot or not, but it is down substantially from 335 million in long-term debt in 2013. So we do see that their property plant is positive. Okay, so it looks like this other row is very likely their capital expenditures, meaning that their capital expenditures have dropped substantially. Again, their other expenses dropped, so there might have been a sell-off of property and plant and whatnot. And so we see, cash from operations is half, maybe even a third of what it was at the beginning of the 10 years ago, but CapEx is much lower. So they're getting back to a more promising cash flow, which has been free cash flow positive since 2016, which is very positive sign. Their depreciation and amortization has gone down, but again, that's probably from them selling off assets, and it's still much higher than their capital expenditures. But anyways, their use of cash is share repurchases, debt reduction, very heavy, huge net reduction since 2019, and a lot of share repurchases. So that's the majority of their free cash flow. So let's start making some. Oh, they do have a dividend now. It pays $7 million, and from a yield standpoint, it is 3.6%. So a 3.6% yield on $7 million in relation to free cash flow averaging in the last 4 years or so of 80 million is, pretty much nothing. So huge production of free cash flow in relation to this market cap. You see free cash flow, again, this other line is CapEx, so it is averaging about 70 million. So you're looking at 5 times free cash flow. It's kind of interesting to me. On the revenue side, I don't think we'll be seeing a whole lot of growth here. Maybe this is one that grows 3% or so. 13p, less than the market. just because enterprise value is a little bit higher. Not terribly concerned about it, but I think I'm fine with that 13. Less growth in the market, maybe less return on invested capital. For margins, I mean, earnings are so much lower. Maybe we'll do 7 and 9%. Share change 1% would be about 4 million. Offset stock-based compensation, looking at about 2 million. Seems kind of reasonable. So 12 million, reasonable. Then they're paying down debt, maybe making some acquisitions. I mean, this is interesting. This is definitely interesting. Let me look at what their historical price to earnings and price to free cash flow have been. So P has been all over the place. Free cash flow is obviously much more consistent, and it's historically averaged about 5. So this would definitely be something I'd want to look into. But again, they had a lot of debt over here, and they've been paying that off. So maybe not 5, but maybe 8. So right now, all I did was I balanced out what I think the P and price to free cash flow should be at the end of 7 years with what it's been historically. And again, historically, we're looking at about a 5 P from what I'm seeing. But that 5 doesn't take into consideration the fact that their debt is a lot lower now. So again, long-term debt down from 335 to 66 million. They just have a lot less net debt. So we're not as concerned with the balance sheet. So with these assumptions, it's looking kind of interesting. This would definitely be something that I'd like to do a deeper dive in to just understand it better. And the thing about it is not every company is going to make sense to you. So even if it looks like a deal, but you can't fully grasp, maybe why the valuation's like this, why that, then don't invest in it. Everything that should be extraordinarily obvious for you to invest in it. Just my perspective. But I hope 27% drop to get to the return I'm looking for here. This could be an interesting company to look at. So I hope you enjoy the video and have a great rest of your day. Thanks.